What does the data tell you about the environment right now as it relates to interest rates and inflation? I mean, wage growth of 2.9% year over year in that jobs report a week ago. Unnerved markets. I know you want to see volatility. I mean, that's obviously a great thing for your business. But what should we be thinking about inflation, about wage pressure, this tight labor market, and higher interest rates and their impact on the stock market?
All right. So we've got to remember that the headline unemployment rate is not a true full unemployment rate. It's people looking. So if someone was unemployed and they chose not to look, they come off that list.
Mm-hmm.
But
right,
when they decide to, hey, I'm hearing all this stuff on Maria's show, maybe I should go back out there, up we go. And what will happen is that there's lots of employment still left in America to grow without really having employment-related inflation. I just don't buy that.
Okay.
I think you're going to get ticks of it back and forth, and you're definitely going to see interest rates rise because, let's face it, this was a spring that was crushed too low.
Right. I mean, they went to negative in some areas.
Right. And you know, what I always said is a 1% interest rate gets the Fed to first base. Right? At least, God forbid, if something happens to the economy, they have something to pull.
All right.
I mean, at 0.5%, what are they going to do? Make it a quarter? Nobody cares.
Well, they're talking about 4 rate hikes at this point in 18. You don't think they'll go 4?
I think 3 would be more in the cards.
Okay.
I think they're going
but
to
even
worry.
there, you're coming from such low levels. Why are people freaking out about these numbers?
Because they have nothing else to do. You know, look.
They're looking for an excuse.
Think
after
about
this
how
huge
high.
rally.
Come on. Think about how much we grew in the month of January. Right? Okay, you give a little back. So what?
Mm-hmm.
I mean, really, yes. Did you give it all back on Monday?
Right.
Right? And does that change things? Yes. And should there be more volatility in this market? I think there should be. And the reason there should be is because there are lots of moving parts. Right? Who's ever thought about an adrenaline pop from a tax cut for every corporation in America, coupled with interest rates rising?
Yeah.
Right? That's a lot of moving parts. But I think what's going to happen is, yes, inflation's going to go up, but it's going to go to where the Fed always wanted it to go.
2%.
You know, to about 2%.
Yeah.
And it's going to stick around 2%. Sure, will the 10-year Treasury hit 3%? Trust me, it's going to go over 3%. What's the difference between 3 and 3.25?
Is that what you think, 3.25, or are you at like 4%?
No.
No way.
No way.
No 4% in 2018.
No. 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 That's just not happening. And if the economy grows so beautifully that these things are a possibility, you have to remember the first part of that sentence. The economy is growing so beautifully that interest rates need to rise. That's not the bad part.
Right. I mean, they're rising for good reason.
Right. That's not the bad
better
part.
Economy.
Right. That's why I said there's no horizon of horrible.
What?
You know, there are lots of things to worry about. I'm not suggesting there aren't lots of things to worry about, but what I'm suggesting is when you go outside and it's gorgeous and it's sunny, I didn't say there's nothing to worry about. There's just nothing to worry about today.
Oh, God, that sounds like a scary comment. Look, people are afraid when they see the Dow Jones Industrial Average down 1,000 points, 1,100 points. But you say volatility is your friend.
Right. Well, our company makes money when the markets go up or down. So we like volatility. We like when the New York Times or you say chaos, in the markets, we're like, this is wonderful.
Right.
We're busy, busy, busy. But it's been too quiet. You had volatility because quantitative easing, right? And it's hard to understand what that is. Here's my simple thought.
Well, the Fed took rates down to nothing.
It's a bomb blanket on moving stuff around, right? The government buys bonds. Everyone else in the world would hedge it. Say, geez, I'm worried about interest rates. I'll hedge it. And then that would be another trade, and someone else would do another trade. And that's all volatility. Instead, the government just takes it all and eats it and doesn't care.